Good morning to all of you, and on behalf of the Spanish Chamber of Commerce in the UK, I'd like to give you a warm welcome to this morning's webinar. As you may know, on last Wednesday, the Chancellor of the Exchequer, Rachel Reeves, presented the first autumn budget of the Labour Party. This has been a highly anticipated announcement because this is the first Labour budget in 14 years, and also because this is the first time that the UK has a female Chancellor of the Exchequer. There have been many new measures delivered, not all explained on Wednesday during the presentation. So today we are lucky to have Alan Tam and Alejandro Abad from our Member Blick Rothenberg to deliver an in-depth insight to this first budget of the Labour Party and how the announced measures will impact both individual and businesses. As you may know, Blick Rothenberg is a leading tax, accounting and business advisory firm. They offer audit services as well as advice on corporate and personal tax matters. We are thrilled to be collaborating with them to deliver today's webinar. I'll introduce our speakers of today. Alan Tam is a partner of the firm, expert in global mobility. He has over 23 years experience working in partnership with companies, advising on the tax, social security, and payroll implications of their cross-border workforce at all levels of seniority, as well as supporting them in managing their global mobility functions cost effectively, ensuring good governance is in place and all risks are properly managed. He has also spent a period in-house working within the global mobility function and therefore understands firsthand the challenges faced on day-to-day basis. Joining us is also Alejandro Abad Algarra, Corporate Tax Senior Manager. He's a chartered tax advisor and Spanish qualified lawyer with over 9 years of professional experience in the field of taxation in the UK and Spain. Alejandro specializes in corporate tax with a strong focus on transfer pricing and international tax, advising worldwide groups on establishing UK operations and the tax consequences of this, designing and implementing appropriate transfer pricing policies, and dealing with the UK and Spanish tax authorities in tax and transfer pricing cases. As a friendly reminder to all, this session is being recorded so that we can share it with you later. And throughout the duration of the session, you can submit your questions via the Q&A function, and they will be addressed by the speakers after the presentations. Now, without further ado, I'll hand over to you, Alan and Alejandro. Thank you both.
No, thank you very much, Miriam, and good morning, everybody. So, as Miriam said, there's a lot going on in the world. There's a small matter of what the press call an historic presidential election going on in the States as we speak. And as Miriam said last week, we had our first budget under the new Labour government. And I am sure you've read a lot of outputs, through the press, through the media. And the purpose of today's presentation is really just to concise and go over the key highlights of that budget, focusing on, how that potentially impacts individuals and corporates. So we'll first start off by looking at key highlights before Alejandro will then take us through the personal taxes and IHT along with corporate and business taxes elements of the budget before I will then talk through the non-domicile changes, part of my bread and butter. And then both Alejandro and I will finish just by summarizing the winners and losers before we take questions from the floor. Sorry, next slide, please. Yes, and next slide, please. So in terms of the key highlights, I guess the first thing to say is the government probably did a great job because they potentially scared us all half to death in the run-up to the budget through various, commentators, the press, sort of going through what the potential budget changes might be. And in essence, once the budget happened last week, it wasn't as bad as the government had or the press had made it out to be to begin with. However, having said that, there are still significant changes impacting non-domiciles, investors and companies, although there's a little bit of good news for people coming to the UK on short-term assignments. So just to go over the key highlights, the one that I think hopefully everybody is familiar with is that UK employers NIC, which is the UK Social Security, has increased to 15, or should I say will increase to 15% from April 2025, and the threshold at which contributions are due has also been significantly reduced. And I think that, crunching some numbers, that I think for companies that adds around about £615 per employee cost from April 2025 onwards. You may have also heard that the UK capital gains tax rates have increased, which Alejandro will go over later. In a bit of good news, because the personal tax thresholds on income tax and INSC have been frozen for quite a few years, they will again increase in line with inflation from the tax year beginning the 6th of April 2028. Linked to all the non-domicile, you will have heard that the non-domiciled regime will be abolished from April 2025 and will be replaced by a residency-based system. That will also be true of the IHT system, which again will have a new residence-based system from the 6th of April 2025. One thing you may not be aware, which was, and I know it's been talked about in the press, but has been hidden, is that unused pension funds will be added to estates and subject to inheritance tax from April 2027, which could be a significant change. For individuals coming to the UK, and I'll explain this later on, we have a relief called Overseas Workday Relief, and that has been simplified. The CGT rate on carried interest will increase to 32% from April 2025. And then the last one, again, a lot of publicity around this, and again, hopefully something that people will be familiar with, is that VAT will be charged on private school fees from the 1st of January 2025. So at this point, I'm going to hand over to Alejandro, who will just talk through some of the changes in more detail around personal tax, CGT and IHT.
Thank you very much, Alan. Next slide, please. Yeah, so I'm going to talk about personal tax, capital gains tax, and inheritance tax, although you will note that there's no personal tax slide here, mainly because there hasn't been any changes in the personal tax side, just the fact that from 2028, 2029, the thresholds will increase in line with the index prices. So there's not much that we can talk there, other than obviously non-doms, which Alan will cover later on. But then on capital gains tax, so the rate of capital gains has been increased, and that was made with immediate effect. So from the 30th of October, so from last week. So from 10% to 18% for basic rate taxpayers, so taxpayers that have income of less than around £50,000, and then from 20 to 24% for higher or additional rate taxpayers. So the way capital gains tax work together with income tax, so you first use your band for income tax, and whatever is left is the band that you have for capital gains tax. So so the rates have increased 18 to 24%. Business asset disposal relief, what used to be called entrepreneurs relief. So if you sell your business or if you sell assets that are related to your business, up to £1 million of the gain, that used to be charged at 10%, and with any extra was taxed at 14%. So the ban has been left, so there's still £1 million of gain. That was something that was discussed, but then in the end, it's been left as it is. But then the rates have increased to 14%. It was 10 and 20% in the past, so that now the rates have increased. The main rate from 10 to 14% from April next year, and then from 40% to 18% from April 2026. And then finally, investors' relief. The lifetime limit has been reduced from 10 million to 1 million with immediate effect as well. And the capital gains tax rates have been increased in line with business asset disposal relief. So from all of these, obviously, if you want to sell something that doesn't qualify for business asset disposal relief or investors' relief, the new rates will apply from now. But you will know that the main rates for business asset disposal relief and investors' relief will increase from April 2025. So there might be an element here of planning. If you're planning to sell shares that are unquoted, to which investors' relief would apply, then you may want to consider to sell them now, because if you sell them post April 2025, you will be taxed an extra 4% on the gains. So there's an element of planning here that you may want to consider. Next slide, please. On inheritance tax, this reform is quite aligned to the reform on the non-dom, which Alan will cover later on. Basically, so now, if you are a UK resident, if you have been a UK resident for at least 10 out of the previous 20 years, all your worldwide state will be within a scope of inheritance tax, regardless of where the assets are based. In the past, and still in the current year, because this change won't happen until April 2025, you had to be you had to have been resident in the UK for 15 out of the last 20 years to be considered deemed domicile. If you didn't have a domicile of origin or choice in the UK, so now this is going to change as well. So if you've been residing for the last 10 years, in the last 20 years, then all your worldwide assets would be subject to UK inheritance tax. And there's also a new rule for long-term residents that leave the UK. So there will be a 10-year trail, which basically means that you will have to wait for 10 years before you are free from UK inheritance tax. If, for example, you want to come over to the UK. The nil rate ban and the residency nil rate ban will be frozen, so they will still be £325,000 for the first one, £175,000 for the second one, with the option of your using your partner's rates as well, so up to £1 million in total. Agricultural property relief and business property relief, these reliefs used to exempt from inheritance tax the business assets and agricultural assets. The relief was 100%, but now from April 2026, so still one more year, it will be capped at £1 million, and above £1 million, the relief will only be 50%. And if you give alternative investment market listed shares, the limit will not apply anymore. The 1 million limit will not apply, and everything will be subject to 50% relief. And finally, as Alan mentioned as well, from April 2027, unused pension funds and death benefits payable for a pension will be brought into the scope of inheritance tax. So a number of things to consider from an inheritance tax perspective, some of them from April 25 and some others from April 26 and 27. Next slide, please. And then on the corporate and business side, so this is probably the measure, as Alan said, that everyone has been talking about, the increase in national insurance contributions for employers. So from April 2025, so again, not with immediate effect, employers' national insurance contribution rate will increase from 13.8% to 50%, meaning that hiring people will be more costly for companies. The secondary class one NIC threshold, which is the threshold from the point where NICs are paid, will be reduced from £9,100 to £5,000, meaning that the NIC bill will obviously increase together with increase of the rate. And then employment allowance, which is basically the credit that businesses are given in NICs, will increase to 10,500 from £5,000, and the 100,000 cap will be removed. Basically, meaning that your bill once you have calculated your NICs will be reduced by £10,500, which is obviously to counteract some of the effects of the first 2 points. So there's a basic planning point around this. So because the rates are not going to increase until April 2025, if you are, for example, considering paying bonuses, a lot of companies pay their bonuses to their employees in April. So again, there might be an element of planning here, trying to advance the payment of those bonuses to March, for example, to try and save on the increase on the national insurance rate. So that's something that companies may want to consider ahead of the next financial year for them. And then the national minimum wage has also been increased. So there's three different rates depending on the age of the employer. So for over 21s, it's been increased to £12.21. For employees aged between 18 and 20 years old, it has been increased to £10. And then for under 18s and first year apprentices, it's been increased from £6.40 to £7.55. So yeah, again, maybe the wages in London are larger than this, but again, if you are paying your employees based on the minimum national minimum wage, this is something that you will also have to consider from April 2025. And next slide, please. Corporation tax, not many changes here, which has been obviously very welcome. Has been very welcomed by companies because there's actually a promise of long-term stability. So the headline of corporation tax, the headline rate of corporation tax will be capped at 25%, which is the rate that has been in place since April 2023, and the small profit rates for profits below £50,000 will be maintained at 19%, which is a good thing because it gives stability to businesses so they can plan properly. The capital allowances food expensing regime will remain untouched, which is like being able to fully expense all your capital expenditure, and the £1 million of annual investment allowance will also remain. The current rates of R&D tax relief will be maintained, and this is also very welcome because there's been a number of changes over the last few years in the regime. So certain stability here was really needed. The patent box regime will not be amended either, nor will the taxation of intangible fixed assets regime be changed either. HMC will publish extensive guidance on the Pillar 2 rules, which is also very welcome because you may be familiar with these rules or not, but they are really complex. And the global rules trying to understand to which companies apply, the adjustments that you have to make, and they are already in place, are really, really complex. So it is really welcome that HMC will publish this guidance. And finally, one thing that is pretty relevant as well is that HMC will now consult on removing the transfer pricing exemption for medium-sized businesses. So those businesses that have over or less than 50 members of staff and either less than these are small businesses. So transfer pricing rules exemption will only apply to businesses that have less than 50 as staff or either less than 10 million euros annual turnover or gross assets. So obviously, any business that is above this threshold would be caught by the transfer pricing rules, which will bring a lot of businesses into the rules. And also, this measure goes in conjunction with the increased scrutiny over transfer pricing following the previous consultation that HMC made last year, and also the recent publication of the HMC's guidelines on help with common risks in transfer pricing. So yeah, again, transfer pricing is something that is becoming more and more popular, and the tax authorities know that they can get a lot of money out of it. So yeah, just be mindful of the rules and yeah, because they may apply to you now. Next slide, please. And I'll hand over to my colleague Alan to talk about the non-dom changes.
No, thanks very much. So on the non-dom changes, and just to set the scene very, very briefly, you may be aware there's been a lot of media around non-domiciles, or I call non-doms, and there's been a lot of public perception around wealthy foreigners, high net worth individuals getting tax breaks. But then on the flip side, you could also say, well, these non-doms have also made the UK their home, setting up homes and businesses, investing in the UK. And I'd also question, are we any different to many countries around the world, especially in Europe, who have similar regimes that are in place to attract wealthy expats and foreigners, such as Italy, Portugal, and even Spain with the Beckham law. So I think in summary, the non-dom issue has always been a politically sensitive issue, but since it's now been scrapped, and I'll go over the changes in a minute, is what will this mean? And I think for us in the business, we're thinking, well, will this mean wealthy expats going to places such as Italy and Switzerland, moving their assets with them? Could it even damage the damage London as a global financial centre and the UK? Does it make the UK less competitive compared to other locations? So those are considerations which I think we're all considering, given what's happened with the non-dom regime. But as I said at the very start of the presentation, it's not all bad news, because there's a particular relief called overseas workday relief, which I'll go over again in a minute, which for short-term expats, which actually will attract perhaps people coming here on shorter term assignments, because it's actually been structured in a much more simpler way, and it's easier, a lot easier, should I say, to claim that relief. So I mean, over the years since the non-dom regime, the abolition of the non-dom regime was first put in place during the old Conservative government in the spring budget earlier this year. And and to be fair, I have seen people move from the UK, moving to countries such as Italy and Spain, for example. The question is, will this continue? The question is, will tax policy drive this, or will London's preeminent position and the ease of doing business in the UK still attract people to invest and do business here? So these are all the considerations I wanted to mention about the non-dom before I just launch straight into the non-dom changes, because as I said, there's been so much publicity around non-doms. I thought it was important to set the scene. So in terms of what is changing, so as hopefully a lot of you will be aware, the non-domicile regime has been abolished, and it will be abolished from April 2025, and it will be replaced by this new regime, which is called the Foreign Income and Gains regime, or the FIG or FIG regime. So what is this FIG regime? Well, it's available to individuals for the first 4 years of UK tax residence, but one of the key conditions about being able to claim this is that those individuals must be UK non-tax resident for all of the 10 UK tax years preceding the first year of their UK residence. So it's similar to the IHT tail that Alejandro mentioned earlier. There is a long 10-year tail that you must meet in order to claim this. It also means, which hasn't been available previously, is UK nationals can claim the FIG regime. So if I decided to go and live in the UAE or Australia for 10, 11 years and break UK residence and come back, I could potentially benefit from this. The claim will be made on UK tax returns. And again, hopefully as you're familiar, the filing deadline for tax returns is the 31st of January following the end of the tax year. And in terms of how you determine whether you're resident or not, either for the 10-year test or for these first 4 years, it will be based on the long-standing UK statutory residence test, which can be a bit complex. The key thing is, if you're eligible for this foreign and for this FIG regime, then effectively all foreign income is that you have during that period is not taxable in the UK, whether you bring those funds into the UK or not. People who are in the UK at present who meet the 10-year test but maybe have arrived this year can also benefit from the FIG regime from April 2025. It just means your 4-year clock is already ticking. So if you've been here, you arrived this year and you're resident this year, then you've got 3 years left to claim. So the clock doesn't reset on April. The clock starts ticking from now if you're currently here. And if you do claim the FIG regime, then you lose your eligibility for the personal allowance and the annual exempt amount for capital gains tax. Sorry, next slide, please. So linked to this, and again, just to add some context. So previously, we've always had a relief for short-term expats coming to the UK called overseas workday relief. And the current conditions are that in order to claim it, you need to be non-domiciled. And you mustn't have been resident in the UK in any of the 3 tax years preceding coming to the UK. And provided you meet those conditions, if you come to the UK to work, then a proportion of your employment income relating to the time that you work overseas is not taxable in the UK, provided that element is paid offshore and kept offshore. So, for example, very simple example, if you earn 100,000 euros and you spend 40% of your time working outside the UK, then 40,000 euros will not be taxable, provided that's paid offshore and kept offshore. And historically, we've had to do some fairly complex overseas bank account structuring in order to maximize relief for that claim. I'm not going to go over the rules because there's lots of tricks and traps in terms of how you can maximize that claim, and it really depended on how you structured your overseas bank accounts, making sure you just had one account in which your employment income was paid to fully benefit from this relief. From the 6th of April 2025, this will be simplified. Previously, you could claim this relief for 3 years. Now, this relief has been aligned to the FIG regime, whereby you can claim it for the first 4 years of tax residence. Similar to the FIG regime, if you've already been claiming it, then you'll be eligible for the remainder of the 4 years. And then the biggest thing is that this relief has been simplified, so there's no longer requirement for your overseas, so the overseas part of your employment income to be paid offshore and kept offshore. That is no longer an issue at all. You can be paid anywhere and still claim this relief. The other big change to overseas workday relief is the government have announced the limit. So for each qualifying year, the maximum claim you can make is the lower 35% of your qualifying employment income, or £300,000. So to use a wacky example, let's say somebody's employment income is €1 million or £1 million, shall we say, and they spend 40% outside the UK. So on the old rules, it would have been potentially 400,000 claim. Here, it's been capped because it's gone above the 300,000. So the two things to take away are there's no longer requirement to be paid offshore, and there is a cap in terms of the maximum you can make each year. Payroll has been simplified as well, because in the past, if you can claim this relief, we've been able to apply to HMRC to apply for what we call a Section 690 directive, which effectively restricts the pay as you earn due to an estimated percentage of the employee's UK workday. So using the 60-40 example, if they're spending 60% of the time in the UK, we could apply for a directive that restricts pay as you earn to just 60% of their income. It was quite painful because HMRC have been very, very slow in terms of approving this. So strictly, you're not meant to apply this restriction or directive until HMRC approve it. Going forward, this will be simplified again. So employers will be able to notify HMRC about the reduction the moment they notify them, without having to wait for a formal approval. So once they've been notified, they can then reduce pay as you earn on the employment income relating to UK workday. So again, an administrative ease in terms of how payroll is run. Sorry, next slide, please, Rebecca. Two other things that have been tied to non-domicile, which I think are worth highlighting, is there's this thing called the Temporary Repatriation Facility, which is, I'll shorten it to TRF because it's quite a mouthful. So that is available for 3 years. And what it is meant to do is meant to encourage individuals who were previously non-domiciled and were able to include their foreign income and gains under the remittance basis rules. And what it is meant to do is to encourage them to remit that income into the UK at the beneficial tax rate. So as I said, it's for those that were previously non-domiciled and benefited from the remittance basis. They effectively now have 3 years in which to remit that foreign income and gains to the UK at a rate of 12% for 25-26 and the following tax year, and then 15% in 27 and 28. And I think it's designed by the government just to encourage these former non-doms to effectively remit that income at reduced rates to encourage ongoing investment in the UK. The other final major piece around the non-doms is the capital gains tax rebasing, and this is really around basically UK resident individuals who aren't subject to the FIG regime will be subject to capital gains tax on their worldwide income. However, again, for former and current remittance basis users, so people who benefited from the non-dom regime, for any disposals after the 6th of April 2025, they basically are entitled to rebase any foreign held asset for CGT purposes at the market value based on its market value at the 5th of April 2017. There were a couple of conditions to meet, so it's not, there's a couple of requirements in order to be able to rebase this, but it is something that the government have put in place to enable capital gains tax rebasing of any foreign assets. Sorry, next slide, please. So I wanted to end this section really with just some observations that we pulled together in terms of the non-dom changes. So I think because in the past there's been a lot of uncertainty, especially in the past couple of years with negative press around non-doms. There's been a lot of uncertainty in terms of how non-doms will tax. In a way, this actually brings that certainty because we know what's going to happen. We know what the rules are, and actually, as I said, for people coming to the UK. Now the rules are clear, and actually, potentially even people like me, if I disappear from the UK and stay away for 10+ years and come back, I can benefit from the FIG regime. And what we'll think is, in terms of companies sending people to the UK, there may be a lot of structuring assignments to perhaps even begin or and end at the start of the start of the tax year in order to maximise, for example, the FIG regime and this overseas workday relief. I think individuals perhaps may want to delay if they do need to remit income into the UK. Is it worth delaying it to the 25, 26 and the following 2 tax years to benefit from this temporary repatriation facility? I think the other thing which we might see, there'll be a lot of planning going on. So for individuals perhaps that may not be able to claim the FIG regime, one thing that many people could do is try and claim to be non-resident of the UK. So either you limit your time in the UK or your connections to the UK so that you are able to become non-resident under the statutory residency rules, or we can play with the double taxation agreement. So if you have a Spanish national coming to the UK, but they're spending significant time back in Spain, that they're equally resident in Spain as well as being resident in the UK, could we play with the double taxation agreements to effectively make sure that individual is non-resident in the UK under the agreement and residence in Spain purely, but for example, by having a permanent home in Spain or making sure their centre of vital interest or their ties and connections to Spain. So I think there'll be a lot of reviews and planning going ahead with companies and their employees just reviewing how best we can plan assignments. How can we, if people are coming here on a short-term basis, could we maximize or plan their assignments around benefiting from the FIG and the overseas workday relief claims, and planning around whether they are UK residents, or can we use any planning to make sure they're non-residents in the UK? Because being non-resident, you will only be taxable on UK source income, UK work days, UK bank interest, and your foreign income will not be taxable, but that's on the basis you're non-resident of the UK only. So as I said, I just wanted to cover off those observations around the non-doms, because I think there is still a lot of considerations going on, and I think we all, as a practice and profession, are still digesting all the changes and working with our clients and contacts just to work through what they all mean for everybody. So just the next slide onto, yes, winners and losers. So what we want to do, so I think Alejandro and I have covered off what the key highlights of the budget, around personal income taxes, IHT, CGT, the non-dom changes and business taxes. And what we thought would be a nice way to end this presentation before we open the floor to any questions is really just to go through what we perceive are the winners and losers. And I guess, the first, and I'll start off with winners. And I guess the big question is, are there any? Because, there's been a lot of significant changes in this budget. And I guess there are to an extent, because as I said just before, I would include non-doms in this, in that they're winners in a sense, there's certainty, because there's been a lot of uncertainty. People have been worried about what's been going on. There's been a lot of negative press. There's been a lot of pre-budget panic, people perhaps wanting to leave the UK and exit the UK, whereas actually now we know what the rules are. There will hopefully be some certainty, and actually it'll be an opportunity for everybody, whether individuals or corporates, to stop planning around the rules and start getting their affairs in order. One obvious one is obviously low-income individuals. As Alejandro explained, the national minimum wage will increase next April, rising also for the younger population. Investors, again, winners in a sense that there's a 10-year extension to the EIS and the venture capital trust schemes to April 2035, although that has to be tempered with what's happening elsewhere with the capital gains tax rates and capital gains taxation. And then final one, drinkers. If you enjoy the occasional pints and you like your drafts, then actually draft duty will be cut by 1.7%, which I think is, as I've said on the slide, is a whopping 1p on your pint down the pub. But obviously, if you prefer your vodka, lime, and soda, not so good, as alcohol duty rates on non-draft products will be increasing in line with inflation. And then the final one, before I hand over to Alejandro, is the income tax and NIC thresholds will be unfrozen. They've been frozen for a long time. So I guess, everybody's been saying it's a stealth tax because they've been frozen and inflation's been continually rising. It's actually been an indirect tax, whereas actually unfreezing them from 28, 29 in line with inflation will actually be welcome, because hopefully that stealth tax that everybody's talking about will effectively disappear. And then, sorry, next slide, at which point I'll hand over to Alejandro.
Thank you, Alan. Yeah, so I want to cover the losers. So it's Alan covers the winners, I cover the losers. It's like, like a conversation. So who we think the losers might be? Of course, employers. And as I explained, the national insurance contribution rate will increase. And there will also be the decrease in the secondary threshold. Of course, there's going to be the increase in the employment allowance, but we understand that obviously the increase in the rate and the decrease in the threshold will have a wider impact. So probably, obviously this will impact businesses, but may this impact employees if, for example, these increases are taken into account when giving pay rises to employees or offering salaries. Of course, this will also impact high industries where the main capital is human, like supermarkets, for example, pubs, but obviously considering the increase in the employment allowance. Investors, obviously, as well, as I said, the rate will increase from 10 to 18%, and then the higher rate from 20 to 24%. No change on the residential property owners. Small win, but still high rates. Business asset disposal relief, investors relief, again, there will be changes there, and this will impact investors and people want to sell their business. On inheritance tax, gift or businesses and agricultural property will also be impacted. So it really, investors will suffer the consequences of the budget. Pensions as well, because most unused pension and death benefits will be chargeable to inheritance tax from April 2027. So again, losers here. Next slide, please. Second homes, something that actually we haven't mentioned, but if you already have a home and you want to buy another home in the UK, there's a supplementary charge in the stamp duty land tax. It will go up from 3% to 5%. Well, it went up from 3% to 5% from last week. So basically, and this includes any home anywhere in the world. So if you already have a home in Spain, for example, and you move to the UK and you want to buy a home here, you have to disclose that. And whatever the rate is for stamp duty land tax, you will pay a surcharge of another 5% on top of that. Not whatever the rate is increased by 5%. It's just additional 5%. So obviously, yeah, that's gonna impact the housing market. Carried interest increased as well from 28% to 32%. and there will be further measures introduced from April 2026. So mainly these will be taxed as employment income for self-employed. Non-UK domicile individuals, of course, as Alan explained, the new regime may not apply to them. Private school fees, so these will be subject to UK VAT at the standard rate from January 2025. There's anti-forcing measures here, so you may have read that some parents try to pay the fees for the coming year before the budget, but anything that has been paid from July 2024 will be caught by the new rules. And finally, those with private jets will have an uplift of 50% in the rate of passenger duty. Probably not something that affects all of us. But yeah, if you know someone that might want to travel to London, from London to California, as the Chancellor said during the budget, they will be affected by this. Yeah. Thank you very much.
Thank you so much, Alejandro and Alan, for this interesting presentation, for your insights. As we said, very valuable for all, especially for all the people working in the UK from Spain. So we are updated on all our benefits and everything that changed basically for us. So we will now open the floor to questions. We have like 15 minutes for questions. So I encourage all of you, all the attendees, to send your questions via the Q&A function, so that Alejandro and Alan can read them and start answering to them. We have a couple of them. So if you want, we can start with those. For example, Alejandro or Alan, if a sale contract is entered or exchanged into before the 30th of October, but completed after that date, what CJT rates apply?
I'll do that one because that's capital gains tax that I covered during the presentation. I think this is a very good question, because for capital gain tax, the tax is charged when a contract is exchanged, so basically signed by all parties, regardless of when it is completed. So, for example, if I sign a contract for the sale of shares, and I actually transfer the shares in 2 months after the contract, then the moment when capital gains tax is payable is when the contract is exchanged or signed, unless the contract is conditional. So obviously the problem here is that, and everyone on this webinar might be aware, for a few weeks right before the webinar, right before the budget, there were a lot of speculation around the budget and what was going to happen. And obviously capital gains tax is something that is being discussed a number of times, and people may have thought, well, in the event capital gains tax increases, let's exchange the contract now, and then if it increases, we'll have to have a look at the rates that were in place when we exchange the contracts. So basically, even though there is an anti-forcing rules as such, as for the VAT, for example, obviously the government has taken this into account. So for contracts that were unconditional, so they were going to happen anyway, but were uncompleted before the 30th of October 2024, the old rates will still apply, provided that the parties to the contract can demonstrate that they didn't enter the contract with the purpose of obtaining a tax advantage by reason of the timing rules in the legislation. And if the contract is between connected parties, they have to demonstrate that the contract was entered into for wholly commercial reasons. So they will have to demonstrate that. So this is very complex and fact and depends on the facts and circumstances. So if you are in that situation, feel free to reach out, and we will be able to provide you with further guidance in this respect.
We'll certainly do. So let's go with the second one. What are the current UK TP documentation requirements?
That's for me as well. Thank you for that question. So I guess what I would like to do here is to differentiate between transfer pricing rules and who they apply to, and then transfer pricing documentation, because I think in countries like in Spain, where there are no safe harbors for transfer pricing, these are normally misunderstood. So I mentioned during my presentation that that HMC will consult on whether to remove the transfer pricing exemption for medium enterprises. So basically, if you're a small or medium-sized enterprise, you have less than 250,000 employees. Sorry, not 250 employees, not thousand. Sorry, and less than 50 million euros turnover, or less than 43 million euros balance sheet total. You are exempt from transfer pricing rules in the UK. You may be exempt in the UK, but if you've got cross-border transactions, you may not be exempt in the other territory. But that's an exemption from transfer pricing, so you don't need to apply transfer pricing rules to your intergroup transactions. If you are above those limits, or in certain other circumstances, you are caught by the rules. That is different from having to prepare transfer pricing documentation. So transfer pricing documentation as dictated by the OECD guidelines, including master file, local file, and country-by-country reporting, only applies to groups of companies with revenues exceeding 750 million euros, which means that if you are a large enterprise, but you are below that 750 million euros, you still have to prepare transfer pricing documentation, but that doesn't have to be in line with the OECD requirements. So what you have to show to HMRC is that your transactions have been priced at arm's length. Uh, there's no guidance as to what kind of documentation. So in reality, companies that are above the medium-sized enterprise levels prepare OECD compliant transfer pricing documentation, because even if HMC in the UK will not ask for that, that is helpful for other jurisdictions, and that gives clearance. That gives a clear path and clear guidance as to what needs to be included in the documentation.
Mhm. We have another one regarding the non-doms. In general terms, after what you've said, both of you, does the non-domicile changes make it easier or harder for expats coming to the UK? And I'll add a second part of the question later.
Yeah, I could say that one. I think in a way it's easier because it adds a bit the certainty around in terms of what the non-dom rules are, because I think, as I said in the presentation, there's a lot of uncertainty. People were making decisions based on what the government might do, whereas I think now that we know what those non-dom changes are, it allows people the opportunity to plan and effectively plan around how they want to protect their wealth, how they want to manage their time in the UK. I think if you are an expat and coming into UK for a shorter term basis, like basically anywhere up to 4 years, I think it actually benefits you, because if you're an employee and you've been seconded to the UK for less than 4 years, you've now got the you benefit from what we call this overseas workday relief, and actually it's a lot easier to claim because you don't have to do any complex bank account structuring. You can be paid anywhere and still claim that relief, provided you meet the conditions for the FIG regime. So, and I think in a way it helps. Although on the flip side, I think, does it make the UK more competitive? I think there's a big question mark on that, because you look at other European regimes and their, for example, equivalent expat regimes, and actually how do they compare? But as I think I said in the presentation, we can't let tax drive everything. So there's a lot of things to balance and weigh up at the same time.
Mm-hmm. And you partly answered the question already, but how should we claim for it? Is it a simple process? Is something that we can do directly, say online claim, or is there a more complex process?
No, it'll be predominantly claimed on your tax return. So the claim for the FIG and the claim for the overseas workday relief will be claimed on your tax return. So if we let's fast forward to October 2025 and we're in the 2025-26 tax year, the claim will be made on that return, which will be due on the 31st of January 2027. So the UK filing deadline is the 31st of January following the end of the tax year. So this will all come into play for the 25-26 tax year. So yeah, claimed on the return. The revenue typically will randomly select returns for audit. It doesn't mean they think anything's wrong with the return, but they'll just do a random selection of returns for audit. And I think that's when they'll probably look into the claim by checking, for example, diaries, work days, how often did you work outside, etc. But that's only on the occasion that the revenue does randomly select your return for audit.
Okay, good. So we have a couple of more questions via the Q&A function. I think you are able to access. Maybe you can read them out loud. Sorry, Alejandro, because I cut your presentation just at the end. So if you'd like me to go back, me and Rebecca to go back to the last slide where you say you explain how you can.
No, we can't. No problem.
No?
What we can do is we can just answer these two questions, and then we can go back and just finalize the presentation with that.
Exactly. So we finish the presentation with that after answering all the questions.
Yeah, of course.
To make clear everybody how you can help them.
No problem. So we've got two more questions. So one of them says, if you are a UK business looking to expand your business into Spain and have a family residency in Spain, are there any time, tax limits, implications regarding how long you can reside in Spain per year? Revenue will come from existing and ongoing UK clients and new Spanish businesses. So actually, there's a lot of areas to cover here. So Alan and I, because this is what we see all the time, I don't want to summarize everything, but obviously, if you're in this situation, I would encourage you to reach out to us and seek for further advice. So we can provide Spanish tax advice. So we can't really comment on what will happen in Spain based on local legislation, but what we can give is some guidance as to what are things that you need to consider. So from a business perspective, if you are a UK business and you move to Spain, I mean, if you are the director of the business, and basically you manage and control the business from Spain, you may create a corporate residence issue, basically because the UK business will be UK resident by virtue of incorporating in the UK, but there's rules in Spain for businesses located somewhere else but centrally managed and controlled in Spain. So you may have a problem with being double tax resident, so dual tax resident. Your business will be resident in Spain and in the UK. So you will have to go to the UK Spain tax treaty to tie break the residence regarding one of the territories. But until that happens, you may have to pay tax for your business profits both in the UK and in Spain. Assuming that you are considered only tax resident in the UK and not in Spain, you may create a permanent establishment in Spain. So basically, if you carry on the business of your company from Spain, you may have to attribute part of the profits of that business to Spain and pay corporate income tax on those profits in Spain. You may then be able to claim double tax relief in the UK for those, so there will be no double taxation really, because actually the rate in Spain of corporate tax is 25%, and that's the same in the UK. So, but there will be compliance obligations, etc. There's no time. There's no limit. Time limits here. It can be, so normally it is more than 6 months in the calendar year, but it may also be the case if you constantly travel to Spain and you have a pattern that you follow. So what I would always say is try and seek tax advice ahead of traveling to Spain and setting a pattern of you working or managing your company from there. And I will let Alan talk about the personal tax implications.
Yeah, I mean, from a personal tax perspective, again, you're. I said unfortunately, we're not Spanish tax experts, but we can obviously, work with our partner firms to advise. But I think in terms of Spanish tax, it's like, well, if you do meet the conditions to become Spanish tax resident, but perhaps you're spending significant amount of time back in the UK and you're UK resident, then actually could we use the double taxation agreement to effectively declare which country you are primarily resident in? And as I said in the presentation, with these new FIG regime, which only lasts 4 years before you're taxable on your worldwide income and gains, perhaps there's some planning to do to, is it better to be resident in Spain or non-resident in the UK, for example, because will you get better tax rates in Spain compared to what your income and assets will be taxed in the UK? So there's planning around that in terms of where should you be resident? Is there flexibility in terms of how you can manage your time in both to make sure that you are, for example, Spanish tax resident? And then just moving on, I mean, we talked about the business. I mean, if the business has any employees or any directors, so if you've got like a UK business and you've got a board of directors and some of those individuals are Spanish, things to consider are if those individual Spanish directors are coming to the UK to attend board meetings, those days will be taxable. So again, it's just seeking advice that if you've got Spanish directors who are members of the UK board and they're coming here, they will be taxable on the days they spend here performing director duties. And then any employees you send, again, it's just structuring those assignments to, for example, maximize the reliefs that they can get under the new FIG regime and to maximize any claim under overseas workday relief.
Mm-hmm. Yeah, I think we don't really have much time for we've received some other questions. So what we're going to do, we're going to finish the presentation talking a little bit about what services we can provide, and we will get back to you individually on the questions that you've asked and we've not been able to answer because we've run out of time. So yes, next slide, please, Miriam. So how can Blick Rothenberg help? As Miriam said earlier, we are a firm of tax advisors, accountants, and business advisors, really. So we can advise on all areas of tax, and we can also provide accounting or audit services, bookkeeping, VAT registrations and compliance. So as the slide that you've got on the screen says, we provide audit and assurance, prepare statutory financial statements, and do M&A due diligence. We also work on the corporation tax side, compliance, tax advisory. In my case, for example, I focus on transfer pricing and international tax, and I advise clients on setting transfer pricing policies and actually on questions like the ones that you've asked on the chat. And my colleague Alan, for example, he's a global mobility partner, so they advise and provide compliance service on source and business visitors, traditional secondments, compensation structuring, employment tax and reward advisory. There's also, as I said, international tax structuring and planning that I would do, for example, transfer pricing, permanent establishment, customs and duties. We've got a customs department, R&D, VAT, and we also have a source accounting department doing payroll, VAT, bookkeeping, and full financial and support. So yes, if you need any assistance with any of these, you've got our contact details at the end of this presentation, which we will share with you. So yeah, feel free to reach out, to send us an email, and we would be happy to set up a free first call with you to understand what you need and how we can help you.
Yeah, and just to add to Alejandro, I think the main thing is hopefully I really apologise to all the others who have asked questions, but we'll get back to you. I think the main thing is with the first question we answered, what we also do is we work very closely together. So Alejandro and I, although we sit in different areas of tax specialisms, we work very closely together. And our main thing is really helping our clients and individuals to help join the dots, because tax is complex. You've seen how complex this budget can be. So we effectively help everyone join the dots and just find answers and solutions and plan around, some very complex tax and commercial problems. Mm-hmm. So as I said, apologies, but as Alejandro said, we'll get back. And I know there's some really juicy questions which we want to answer, but I think we're basically 1 minute from the end. So unfortunately, we'll get back to you separately.
Yes, Alan, Alejandro, thank you so much. For the sake of timekeeping, we do need to be finishing up. But thank you so much again for this expert vision. Thank you all for attending. Hope you found it both interesting and useful. And as they said, if your question hasn't been replied or you have any more questions, please feel free to reach out and send them an email so that they can help you. Later today, you'll receive the PowerPoint that Alan and Alejandro have prepared, together with the recording of this session. So if you have further questions, please don't hesitate to reach out to them directly. They'll be more than happy to help you. And just as a quick reminder for most of you are already members of the Spanish Chamber, but we have a very active events calendar and many interesting upcoming sessions. For example, if you are interested in learning more about AI, its challenges, and how to make the most of it for your business, please join us next Wednesday, 13th of November for an in-person seminar, this time delivered by biometric solutions provider Veridas. It will be held here at the chamber early in the morning, and we still have a few places available, so make sure to book your place. I'll include the link to the information in the follow-up email. Thank you again, everyone, and have a nice day.
Thank you very much, Miriam.
Thank you.
Thanks everyone that attended. Bye.
Bye-bye.
Thank you all. Thank you, everybody, for coming.